The 2008 financial crisis, it really was the event that defined a generation. It was this massive system-wide failure, and honestly, we're still feeling the shockwaves from it today. But what actually happened back then? Well, to really get it, we've got to dig into one simple but incredibly dangerous idea. I mean, how does a slump in the US housing market become everyone's problem? It's a crazy puzzle, right? It starts off looking like a local issue, but then, boom, it engulfs the entire globe. And figuring out that chain reaction, that's not just some boring history lesson. It's really the key to understanding just how fragile modern finance can be.
And this right here is the whole ballgame. It's the core principle. If you can wrap your head around this one idea that you can't fund long-term, risky stuff with short-term shaky money, then you understand the fundamental weakness that blew everything up in 2008. And, it's the same weakness that could cause the next crisis. So let's break down exactly how it all went down. All right, so to really get the crash, we've got to rewind the clock to the world before 2007. On the surface, everything looked fantastic. But underneath, yeah, all the dominoes were being quietly set up, just waiting for a push. For years, money was just cheap. It was super easy to borrow. And this created this feeling of total stability. It was almost this unspoken belief that prices, especially for something like a house, could only ever go in one direction, up. So when you look at all these conditions together, you can literally see the recipe for a crisis coming together. You've got low interest rates, easy credit, no volatility. It was a party, and it encouraged everyone, from regular people to the biggest banks on the planet, to take on more and more debt. Wall Street calls it leverage, but really it just means they were making bigger and bigger bets with borrowed money. And that made the whole system, well, incredibly fragile. Okay, so the system is fragile, right? It's a tinderbox. Now all it needs is a spark. And this next part, this is where a problem with American mortgages spirals completely out of control and becomes a full-blown global meltdown. And this chain reaction here, it just lays it all out. It all kicked off when U.S. house prices, which, remember, everyone thought would go up forever, just stopped rising. Then people with those super risky subprime mortgages started to default. But here's the real kicker. Banks had taken thousands of these mortgages, bundled them into these crazy complex securities, and sold them to investors all over the globe. So suddenly you've got pension funds in Germany and banks in Japan holding all this toxic American debt, and nobody had a clue how much they were exposed. The whole system just froze. So let's imagine the economy has like a dashboard with warning lights. Well, at this point, several of those key signals weren't just flashing, they were screaming that something was terribly, terribly wrong. The first big red light, leverage. The banks were just so highly leveraged. I mean, they borrowed insane amounts of money that losses that should have been manageable suddenly became existential threats. We're talking about losses that could, and did, wipe some of them out completely. Okay, then you had the credit spreads. The easiest way to think about this is like the fear gauge for the whole market. It's basically the extra price you pay to borrow if you're considered risky. And all of a sudden, that fear gauge just went through the roof. The market was basically screaming that the risk of big-time companies going bankrupt was suddenly way, way higher. And really, it all boils down to this, the absolute foundation of the entire financial system, which is just trust. It completely evaporated. I mean, banks need to lend to each other overnight just to function. And when that lending suddenly stopped, the whole system just seized up. It was like the engine of finance just locked. And because everything is so interconnected today, this shock didn't just stay in the US. Oh no. It spread like a virus across the entire globe, through bank balance sheets, through capital flows, and pretty soon through a massive drop in global trade. Now, this wasn't just some abstract problem for bankers in fancy suits. Not at all. The financial crisis very quickly bled out into the real world and started hitting jobs, businesses, and, real families everywhere. In fact, the fallout was so bad, it got its own name, the Great Recession. And that's not just hyperbole. It officially became the longest and most severe economic downturn the U.S. had seen since World War II. Think about that. I mean, the sheer scale of the damage was just staggering. Look at this number. To put that in perspective for you, a healthy economy usually grows, 2 or 3% a year? This was a drop of over 4%. That's a massive, massive hit to the country's entire economic engine. And this is the human cost right here. At its worst, 1 out of every 10 people in the workforce couldn't find a job. We're talking millions of families losing their income, their sense of security, and in many cases, their homes. And hey, if you had a 401k or any kind of savings, this was an absolute catastrophe. The stock market lost more than half its value. Just gone. That means the retirement savings that people spent decades building up were suddenly sliced in half. Trillions of dollars in household wealth just vanished.
And this is what that actually looks like in the real world, you know? It's not just numbers on a spreadsheet. It's empty storefronts, it's for lease signs, it's businesses closing down. The Wall Street crisis became a Main Street crisis, plain and simple. So after all that, after staring into the economic abyss, what did we learn? And maybe more importantly, why does any of this still matter so much today?
Well, this comparison is just so important because it shows that the core weakness is absolutely still with us. Let's just fast forward to 2023. When a few banks like Silicon Valley Bank went under, guess what we saw? That exact same kind of funding stress popped right back up, and it took massive emergency action from central banks to stop the bleeding. The fundamental problem, that risk of a bank run, it's the same, even if the scale was a bit different this time.
Okay, so if we boil this whole thing down, what are the key lessons? First, a small problem in one sector can absolutely burn down the entire global economy, thanks to leverage and everything being connected. Second, when a real crisis hits, the problem isn't a lack of money, it's a lack of confidence and liquidity. And third, policymakers have this really tough choice. Do you save the system now, even if that encourages people to take bigger risks later? It's a dilemma that never goes away.
Which kind of leaves us with one final big question for you. After going through all this, if you had to pick just one thing to watch every single day to try and spot the next 2008-style crisis, what would it be? Would you focus on credit spreads? Or maybe leverage? The housing market? Your answer probably says a lot about where you think the next big risk is hiding right now.